Once again, good evening, everybody. Greg McDermott with Cyber Trading University. Appreciate you being here with us this evening as we begin the holiday weekend for a lot of people. A little early. The United States, the U.S. equity markets and futures markets are closed. But as we know, the FX never sleeps. So in that spirit, we are here tonight. We're going to talk a little bit of FX. I'm looking forward to it. We appreciate you being here, taking time out of your day. Some of you taking time out of your morning. Others of you taking time out of your evening to be with us, and we really do appreciate that. If you're having any trouble with volume or with your any of those sort of issues, please just make sure you double check that you've got your sound cranked up. We should be okay, or you can email our Cyber Trading University team. They can help you out. Pardon me. Before we get started, I want to make sure we see that risk disclaimer. There is a high degree of risk involved in trading. Past results are not indicative of future returns. Cyber Trading University and all individuals affiliated with this site assume no responsibility for your trading and investment results. You can read the rest of that. I want to make sure everybody understands that we are in an educational forum this evening and make sure everybody understands what that means so that we can all hopefully learn a little bit. I'm not the only guy that's going to do the learning tonight. I always find that talking about trading and talking about this sort of thing always, gives me a little bit more insight. You're never too old to learn, and when you get to that point when you don't want to learn anymore, it's probably time to stop doing whatever it is you're doing because you've probably been jaded or sacked or sort of soured to doing it. So we're going to move on to our next slide. About Cyber Trading University, those of you joining us this evening, if you're here for the first time, CTU is an educational trading institution since 1995. CTU established itself as a leader, but at first working directly with the SOES trading firms, the SOES bandits, if any of you remember the SOES bandits, as they used to call them, teaching them to day trade. Those SOES bandits have laid the groundwork that's allowing you and I to trade as retail investors from remotely almost anywhere we choose in the world. CTU was one of the first to establish itself as a quality stock market trading school. Each of our instructors has a minimum of 6 years of actual trading experience before they begin working with students. Over the past 14 years, we've taught thousands of students to be successful and profitable traders. CTU is headquartered in the heart of the trading world in New York. John, hopefully the super loud has come back in, or hit your volume button. We'll dial it down. I'll try not to be so excited. That's me, Greg McDermott. My mom likes that picture. Got my master's degree of applied finance at Macquarie University in Sydney, Australia. Seems like 100 years ago, but it was only 1989. I have a BS in financial management from St. Joseph's University. Was a crude oil options trader at the New York Mercantile Exchange. Head options market maker for JAS Securities at the Philadelphia Stock Exchange. While I was there, I managed the firm's portfolio of risk for our team of 10 options floor traders. Was also a market maker in the Dell Computer options at the Philex. At the time, Dell Computer was the busiest equity option traded in the country. Directed our off-floor trading operation at JAS for a while, and was also qualified at the ISE, the International Securities Exchange, as a DTR. So what we're offering to you guys tonight, we're going to be able to come back, and you can come back and visit us. Our ProFX workshop is going to be Tuesday, April 29th. We're going to go 5 to 6 and 8 to 9. Plus, we're going to do a live trading and a Q&A the next morning, 8 to 9 a.m. Eastern time with me. So we will be available. There's also an offer. Let me make sure that it's the next one. No. The other thing we're offering tonight, and I will mention it again, but we're offering the opportunity to join Cyber Trading University's cyber group. And we're going to offer a 2-week trial to sit in. I usually get on at 8 a.m. and talk a little forex for 15 minutes or so. And then you have the availability to watch the team at Cyber Trading University, led by Fausto, trade for 2 weeks. It's going to be from the 21st of April until May 2nd. So 10 full trading days for $29. So for $29, you can zoom into the trading cyber group that we have, and you can also join us for this Pro FX workshop, which is going to be in approximately 2 weeks, Tuesday night, Wednesday morning. So reach out to any of our educational advisors at CTU if you have any questions. I should be sharing the screen. If everybody, let me just double check. You should be able to see a slideshow. Has everybody got that? I think we should be broadcasting the slideshow. Okay, great. Let's get into the program. We're going to go through the presentation, and then I'm probably going to reach out and we're going to do a little bit of, I'm going to probably take a look in the market for you, talk about a couple of trades that I have going on now. To be quite honest, with varying degrees of success, can't expect, and I will tell you this, when it comes to education, there is no magic. There is no trader out there who's right all of the time. So we want to make sure that you can hear, you understand that this is about education and hard work. It's not about a magic way to make millions of dollars trading FX tomorrow. So we're going to hopefully, a lot of the things we'll talk about trading FX applies to trading any sort of underlying, whether it's equities, whether it's options, whether it's futures. The mindset and the mentality, those ideas are pretty interchangeable. The underlyings have specific quirks and unique features that you have to be aware of, but the general trader mentality works across all of those things. So we're going to start, after we go through the presentation, I will jump into over to FXCM, who is going to provide the grant for you to join us at this April FX workshop and show you the MetaTrader that we use. Let's talk about trading in the FX market. Why do you want to trade FX? It's the world's largest financial market. Key, it's easy to profit in up and down markets. Most of you, if you're familiar with trading equities, in general, the mindset is up good, down bad. Very simple. And I think that what you find is that if you have the ability to trade the market unbiasedly up and down, it opens up more opportunities for you. Simply buying or selling a currency pair can make that happen. Better risk management tools and more accurate analytics. You have phenomenal tools like the MetaTrader available through FXCM. The tools that are available to you now are so beyond what we used to pay 20 plus years ago. Even if we could afford them, they would have been thousands of dollars or more a month to access a fraction of the ability to analyze and manage positions that are available now effectively for free when you open an account at a brokerage firm like FXCM. The manipulation is very difficult. It's almost impossible to manipulate the FX market because we're talking about countries and governments rather than, now again, some conspiracy theory people out there probably believe, well, maybe there is. But in general, you're not talking as much about insider trading when you're effectively trading one country against another. The ability to margin up to 100 to 1, depending on where your brokerage account is, and the ability to trade with no commissions or fees. Now, some people, there are brokers out there who will charge you a fee but give you tighter spreads. Normally, you'll pay a pip or two, maybe 2.5 pips to get in or out. That will be the spread depending on how actively traded the underlying currencies. Robert, it's an FX class. So you're going to pay, effectively your entry and exit fee is going to be your commission, the spread between the bid and the offer for the underlying currencies. When you trade equities, are you confused by too many choices? Well, you've got 500 to start with, 5,000 to start with in the U.S. equity market. With currencies, in general, there are about 6 major U.S. dollar pairs and 18 major pairs worldwide. So what it allows you to do is focus in on exactly a small number of actively traded pairs, get familiar with the way that they move, and use that to your advantage, gain that local knowledge. You get to focus on those pairs, and there's still plenty of trading opportunity, even in those 6, 8, maybe 10 or 12 pairs that are available. Also, you can trade where you want, morning, afternoon, late night. Corey on here said good morning to me, so that means to me he's somewhere on the other side of the world checking in where it's morning, not here on the East Coast of the U.S. We're going to evening, he's going to morning, so he's probably 10, 12, 14 hours ahead of us. Maybe he's got the lottery numbers. I should check with Corey afterwards to see if they've already picked the lottery numbers. He can send them to me since he's ahead of us. But wherever you are and whatever your schedule is, you can find a time where there are pairs that are actively traded that can allow you to profit trading FX. You can trade where you want. You can trade from your desktop. You can trade with mobile devices. You can trade if you can find a Wi-Fi hotspot at the nearest beach or resort, you can do that too. So you're not necessarily locked down to your desk to make this work. And you can trade how you want. You've got extensive charting, new services available. You can decide that, hey, I'm going to be a longer-term trader, maybe a swing trader, we would call it. So I may put a position or two on that might be a little bit bigger in size, where I'm willing to take a few more pips at risk and do a longer-term trade that I don't have to manage every minute. Tonight we're going to talk about the opposite, the kind of trading where you really need to be sitting in front of your screen and actively managing because you're looking to make small amounts of pips over and over again rather than maybe one large one large trade with pips. So yeah, Corey is checking in from Australia. Good on you, Corey. No need to quit your job, at least not yet. We don't want anybody going out and telling their boss to take a walk. This is a process. You'll get better at this, and you'll find, through experience, and the best way to learn is open up a demo account. Go to FXCM, open up a demo account, practice trading. Practice with when it doesn't matter. Again, it's always different when you've got real money, no matter how small it is. And that's difficult to replicate, but the ideas, the strategies that you develop will be better served in a demo account than maybe putting live money at risk right away. Let's talk about charting to profit in FX. Now, again, a lot of the concepts here are not specific to FX, but the idea of charting in general. I can tell you that 20 years ago or so, the ability to get a chart was a privilege because if you could get them somehow on that thing that was called the back then people probably just called it the ultranet instead of the intranet. The charting was not available. I knew guys that used to get books sent to them once a week that would have the charts from the previous trading week, but they would have to fill them in themselves. So the ideas of charting are applicable to a lot of trading strategies, but let's talk about specifically tonight about FX. Yes, you can open up a demo account for free at FXCM. And I'm going to show you Fibonacci because I was just looking at a chart before I got on here where a Fibonacci may come into play. And what is a Fibonacci retracement? We're not going to talk about every possible charting strategy, but we're going to touch on a couple of them that might help you get your feet wet, give you a feel. So what is a Fibonacci retracement? It's a term used in technical analysis that refers to the likelihood that a financial asset's price will retrace a large portion of an original move and find support or resistance at the key Fibonacci levels before it continues the original direction. These levels are created by drawing the trend line between two extreme points and then dividing the vertical distance by the key Fibonacci ratios of 26.3, 38.2, 50, 61.8, and 100. These are sometimes, and I'll be very honest with you, there are times I believe that the Fibonacci numbers and those levels can become self-fulfilling prophecies. What do I mean by that? I mean that if everybody who's trading a currency pair identifies a Fibonacci retracement and realizes that we are at a 50% level and that could be resistance, there are times when if everybody believes a certain level is resistance, at least in the very short term, it can be that way. And you have to recognize those things that, some of you may think charting is hocus pocus and voodoo, and I respect your opinion, but you also have to recognize that if an overwhelming majority of people believe something, and not just Fibonacci, this goes for trading in general. If a large number of people believe that, a certain price action is significant, the simple fact that people assign significance to it can make it significant. So you have to understand what is everybody thinking. And what people sometimes forget about trading, and I try to remind people, is that we have a tendency in the world we live in to fall into the belief that trading is really screens and charts and data. And what we have to remember is that for a large portion of the trading world, it's still a person or people. And the psychology of the trader comes into effect. And if you can't, just because the machine doesn't necessarily have that sort of mental collective, I guess what I say, mental like collective resolve, then the people that are behind the machines do. So at least, particularly in a short term. I mean, there are lots of times when you'll see a number and you'll see it on charts where a specific level, for whatever reason, may be seen to be significant, and if it's a support level, you'll see the underlying trade to that level and trade off of it. Well, what does that mean? In its simplest terms, and we'll talk about it in a minute, there were more buyers at that level than sellers. Why were the buyers there? Probably as much as anything because they assumed there would be other buyers there. And the crowd gathers at a specific level, determines that this is a number where we want to be buyers, and the buyers outnumber the sellers and move the underlying in a different direction. It doesn't have to be FX. Well, let's take a look at a Fibonacci retracement. I'm going to grab a pen here. Clearly not going to use the yellow. That won't really help me. And I'm going to go here. So the Fibonacci, we started, this is a one-day chart from a month or two ago. Right up here, we have the high point of this one-day chart. Down here, we have the low point of this one-day chart. And here are the retracement numbers. 23.6, 38.2, here's the 50 level, and here's the 61.8 level. So what you can see is when this traded, it traded up to the Fibonacci level, back to this 38 level, came back in. So I want to be clear. You don't want to just go do a trade because it appears that the underlying is, in this case, say right here, sitting on what should be, at least initially, a resistance level at the 38.2. So all other facts be damned, I'm going to sell. That would be a bad idea. But what it does do is helps you identify the idea behind what am I looking to do. It's the first step before you start analyzing other indicators and other charts and those sort of things before you make a decision. So this Fibonacci, I like using it particularly in with the longer time frame, a daily, maybe a 4-hour, to then sort of come up with a direction and then try to use these shorter term charts to pinpoint my entry and my exit strategy. Now, you saw that this was done with candlesticks. I'm not sure if all of you are familiar with it, but candlesticks charts graphically describe 4 price points for each one of the candlesticks: the opening price, the closing price, the high price, and the low price. Lots of good information. I'm going to jump backwards, and you see each of these bars happens to be in green or in red. Each bar there represents all that information: the open, the close, the high, and the low. In these charts that I'm showing you, in fact, on the next ones here, the red bars are down moves, where the open is above the close, where it traded down. So if you look at this, and I'm not going to draw it in here because it's a little difficult on this chart, but this is just sort of a zoomed in look. The red bars are down moves, and the green bars, the hollow green bars, are up moves. So you can quickly get a feel for the price action in each one of the bars. And again, this chart happens to be a daily chart, but if it's a 1 minute chart, it can still be a 1 minute candlestick chart. Now, the movements are a little more extreme, and the information is sometimes a little tougher to sift through when you're looking at a 1 minute chart versus a daily chart. Each of you will find that you develop your own eye for a specific time frame or trading style. Let's go to the next one and kind of dial it in a little bit more and look at, now this is just a blown up version of the last one, and what you'll see is, say for example, on this one here, this line here, that's the absolute high that we traded in that period. Here's the low that we traded. This spot here is the opening price, and this spot here is the closing price. So we closed at a point above where we opened. That gave us a green bar. Now, there are chartists out there that will tell you that, you know, I think I'm gonna take a chance here. Like this one here, the shape of the candlestick is indicative and predictive of future movements. I'll be honest with you, I'm not that much of a candlestick expert. There are people out there who are very good with this. I believe they may call that a hammer, but I'm not positive. Don't really know. I think that's what it's called. But there are candlestick patterns that develop that just purely the graphic movement that you see. I'm not claiming I understand or trade that way. I'm just kind of making you aware of there are ways to take simply viewing the price action to a new level by using candlestick charting patterns. I also like when you're building the charts that you use. Oh, Dojo. I always like that. I forget what the Dojo is, Chris, but I always like kind of a cool name. Or Doji, pardon me. What's a moving average? The moving average is a smooth line connecting the points on a chart calculated by simple averages, the prices for each specified period. You'll see 50-day moving averages, 20-day moving averages. Sometimes you'll see 200-day moving averages if you're trading in a longer term. And what that'll do is there's two things. One, they can provide just a visual indicator of the general movement over a specific period of a number of time periods, but also they can also be seen as support and resistance areas. If you look at this chart here, it's a very simple chart off of Thinkorswim. This line right here, this blue line, is as you can see it right here, it's a 50-day moving average. Pardon me, 50 period, I apologize. This happens to be a daily chart. So the last 50 days, this is the average closing price for the last 50 days. How do we know it's the close? Because it's the description. Now, there are many versions and modified versions of moving averages. If you go into MetaTrader, you can find indicators that are more advanced. I use one you'll see coming up where we have it adds a color feature that kind of gives you a up-down neutral sort of lean. It kind of gives me visually a quick indicator as to what I might be looking at in a possible up or down move. Let's also talk about what else you're going to use, support and resistance, the basic lines of chartists. A support area is an established area, I mentioned this earlier, where buyers have demonstrated they are very willing to buy. That's where we said you found a level that, for whatever reason, I'm not going to try to delve into the reasons tonight, but at those points, buyers have shown up in the past and reversed the movement or continued the movement of an underlying. Resistance would be, not surprising, the opposite of that. It's an established area at which sellers have demonstrated that they are very willing to sell. Now, that doesn't mean that that the sellers are there forever. And I'll be quite honest, there are times when a resistance level that's held very strong and then is finally breached can become significant support levels. We used to talk on the trading floor when we talked about options. If we were looking at a stock, and let's say the stock was trading at, you know, $59, and it's trading at $59.50, and we think it's heading towards 60. I mean, the old joke would be that you were a seller of the stock, you know, at 59 3/4, because you figured there were lots of people at 60, and when it breaks 60, you're then a buyer at 60 and a quarter when you know you're wrong. And that sort of illustrates the idea that these are not static points. They're not absolutes. They can go from a support area to a resistance or the other way, depending on the move of the underlying. What they show is, in the past, there has been a clear demonstration, buyers winning out over sellers or sellers winning out over buyers, depending on whether we're talking about support or resistance. Both of these are key technical analysis terms. We go back to supply and demand, and at equilibrium at these junctures, that's where we find they absorb the value at support and resistance and then move from those. We're looking at the basic function of all charting is built upon, after indicating price, the analysis of that price is built upon, it starts with simply support and resistance. Moving support and resistance into a little bit more of a graphic phase, we talk about trend lines, and these are key structural points. Key price structure points that are the basic for drawing trend lines. We need to have, also, we can use pivot highs. Now again, the trend lines are the ability to connect a number of previously traded areas to draw a graphic representation of the movement of the underlying. We also can show pivot highs and pivot lows, points on the chart at which we've seen a reversal of price based on certain criteria. There's also more support or resistance zones. So instead of just an absolute point on the graph, you may find an area on the graph. And again, let's give that example of an underlying, what was one we were trading today? The US dollar Canadian was trading around 1.100, so zero, so like the figure we would call it. And it takes a little bit of time to clear those kind of areas, and it's not absolutely 1 point. That thing may trade a little below, a little above before the buyers and the sellers sort things out. So instead of trying to pinpoint an exact absolute number, sometimes you need to kind of give yourself a little bit of wiggle and build an area or a zone where support and resistance has occurred in the past. You'll hear me talk about that coming up. Let's talk about, if you're going to enter an FX order, what does that mean? I'm not going to go through all of the basics of an order, but a couple that you're going to need if you open these demo accounts, how to execute trades. This is FXCM, and this is their simple order screen on top of their MetaTrader. And what I want to point out is that you can buy or sell. So this is actually modifying an order, but you can buy or sell, you can institute a stop loss, you can institute your take profit, all in one order. You can also modify these orders very easily from their graphic interface. It's real easy to enter an order in FX. It will not be confusing for you. Very, very, very intuitive. There's somebody who's got a demo with FXCM. The other thing you can do in FXCM that I like a lot, it used to only be available, the NinjaTrader people who work with FXCM, and they work with cyber trading, and they have a great graphics package. But you used to not be able to trade graphically on MetaTrader except through a third-party vendor like NinjaTrader. NinjaTrader has advanced features which are very cool, but you can now pinpoint on your screen with MetaTrader. You can grab the lines, your stop loss and your take profit lines, and you can drag them and move them. I find it very helpful to set the point at which I want to put my stops and my limits. Graphically, it works. Just visually for me, it works very well. And it's a simple, you highlight it, it'll tell you what your maximum profit and the pips you could make or lose, but it will also allow you to drag and reestablish that trade with a simple click. Here it is again. You can just move your take profit. You can highlight it and show exactly what is your profit and the pips you would make if it traded to that part. Again, this is my demo account, so I'm not trading size like that, just as a heads up. Again, here again, you can just, the ability to take FXCM's MetaTrader platform and graphically use the graphic interface to move your trades and analyze it and fine tune it. Now, this is a daily chart. You might want to, and I usually do, if you're trying to find an entry or a limit, a stop area or a take profit area, I go down a little bit on the charts, try to fine tune it into the area exactly where I want it to be. But instead of trying to put a number in, you just drop it where you want it to be. It's very, very, very simple, really easy. The types of orders, and I'm not going to go over all of them, but there are a couple that I want to highlight you really should use while trading FX. The OCO, or one cancels the other order. It allows you to enter a stop and a limit that are tied together. And what that means is once one of those trades executes, the other one automatically by the system is canceled. All the trades I have up right now on my account are set with OCO brackets, they're called. A lot of times I will enter a trade and it will be the entry trade and the OCO bracket that goes around it, and then I will modify that trade based on the graphic interface. But you have to make sure that the significance of this is if you put out an order and establish a position in FX or anywhere, honestly, and you put out then a take profit and then a stop loss, it could happen that, let's say your take profit gets filled and you think, okay, great, winning trade, congratulations, let's do the happy dance. But you forget that you've got a stop loss trade that is sitting above the market. Let's say it was a buy stop above the market and you had a downside trade. Well, if you walk away from your machine, don't notice that that trade is out there, particularly if you're someone who's going to try to take advantage of trading on mobily and using those sort of tools. You could have an open order sitting there that could get filled with the market going against you in a way that you don't want. So that eliminates the ability of that happening by using an OCO order. There you go. Only one trade gets executed. Really a great way to manage. If you get yourself down to where you're trading, we'll talk about this coming up, but if you're trying to trade for 10 or 15 or 20 pips in a pretty active moving market, you want to have that OCO so that once you get filled, you don't have to worry about the other trade, and then you're on to your next trade. It really speeds everything up for you. The other thing you want to do is think about the trailing stop. If you modified this order, you could change it to, this is, of course, the blow up of MetaTrader, but it allows you, again, from the graphic interface, to grab your stop, right-click, click instead of modify or cancel. You hit trailing stop on this trade. What is a trailing stop? It's a stop loss order set below the market if you have a long or you've purchased the currency pair, or a short a sale. Pardon me. It's a sell order if you are below if you have a buy on. It's a buy order if you have a sell on. That will follow will change its limit price based on the difference between the underlying's highest or lowest last trade and the difference that you set. So, for example, I'll try an English version of that. If you picked a 20 pip a 20 pip trailing stop, anytime the underlying moved 20 pips or more away from where your stop is, your stop would slide to keep that 20 pip distance. But let's say we bought a currency pair and our trailing stop was 20 pips below, and then the underlying moves up 10 pips. Our trailing stop would move up 10 pips, and then if the underlying moved down 10 pips, our trailing stop stays in place. So it's a way for you to follow the market. It's particularly good order if you can build a position where you take an underlying to profit and say you're able to take half of your trade off at profit and take the other half of your trade, move it up to either your initial entry point or move it to a trailing stop and sort of let the other half of that profit go in that example. But it's a useful tool in a trending market. You can, as you can see here, modify all the way up to 200 pips if you wanted to. And there again, another way to just grab and drag your trade. Just move it to where you need it. This MetaTrader that FXCM offers is a phenomenal value. And again, there it is showing you how you can just grab trades and move them. Or you can right-click on the line if you don't want to use the graphic interface, click Modify or Close if you wanted to, and modify the trade and change it to a specific number rather than using the graphics. Let's talk about trading FX with not a lot of time. You've got 90 minutes in your day. You got 2 hours in the morning. You think you can find time. 2 hours in the evening. You're not somebody that has access to wireless capabilities and technologies. And if you walk away from your desktop computer or your laptop at home, you are going to be out of the market. Well, what do you want to do there? You want to find a way that you can maximize your time as well as trying to find a way to profit trading FX. And I'm going to just do this as an example. This is a screenshot of the US Canadian dollar chart. And if you look at it, and you just look at this little piece of the chart, now that's 4 hours at a time, you would look at that and say, you know, the eye may fool you and say, wow, 12 hours, nothing really happened, not much going on. Geez, there was no money to be made there. Well, let's look in a little bit closer. Okay, there's a 1 hour covering that same area. You can see on the left side here, this big bar is the equivalent to the previous page's big red bar here. So that's sort of our baseline. And I want to just take a look at these charts. So we've got this one. That's 4 hours. Wow, 1 hour, well, it looks like a little bit went on, but there's probably no money to be made there. Not that big a deal. Wow, there's a 5-minute chart. So now if you look at it in 5-minute increments, you say, man, there's some chart patterns that are coming up here. And man, there was some pivot highs and lows that got breached. And I could have probably done some trading. If you look at these 2 points that we noted here, this low at this point down here, let me just do this a little thicker because that thick one sometimes works a little better. Down at this area, 1.0960, and up here, 1.0997. So that's 37 pips. Well, let's give you an idea of what is a pip. We'll do it really very, very basically. It doesn't convert this way for every single pair, but in general, it's about, if you're trading a standard lot, which would be 100,000 of the base current, the counter currency, you'd be looking at $10 a pip. Again, not all currency pairs equate to $10 a pip, but just in general. So the move from here to here, if you got in pretty close to the bottom, got out pretty close to the top, and you had a one standard lot on, if you made 30 pips on that, that's $300. Now, I'm not telling you to go out and trade standard lots, and I'm not telling you that every trade is going to make you 30 pips. But let's say you were trading a smaller account, and you had a 10,000, which is called a mini lot. You had a mini lot on, and you made 30 pips. That's about $30 in your account over about an hour. And then the move from the top here back from 100, let me clear this for us, 10997 back down to about 109, call it 65. So that's, you're still looking at another at least 25 pips back down this way. And then the move from here to here is about, I don't know, that's 84. That's another 20 pips. So I realize I'm taking the tops and the bottoms, but what I'm trying to show you is that's about a 90-minute run. About. I mean, it might be a little bit more than 90 minutes if we count the bars. But you're looking at, it was a ballpark of 30 pips here. We'll call it just, we'll keep it on the low side. We'll say there was 20 here and 20 here. Now, I'm not saying you bought the bottoms, sold the top. I'm not saying you caught every one of these trades. But, I mean, there's 70 pips in that trade. If you're trading a small account and took 70 pips out on one trade, you'd be ecstatic. But it might take you a day, and you might have to walk away. That might not be what you're able to do. But something as simple as this, there was money to be made actively trading it. And you can trade inside of that. You could trade really, if you looked at it, you know, just like a simple move to here, make 15 or 20 pips. Caught this bottom here, probably 10 or 15, 10 or 15, maybe made 10 or 15. Even if you did 10 or 15 and made a few bucks here, I mean, still talking 20, 30, 40 pips. Again, that's real money as opposed to thinking and waiting for sort of a one big trade. Work on taking out small pieces, because does anybody care here whether you make, you know, 75 pips in one trade or you made 15 pips 5 times? Some of the guys back at Cyber Trading were kidding me about giving this presentation. Like, Greg, finally you're going to talk about doing lots of trades. They said I couldn't put a trade on and then wait around a day to see what happens. Like, I'd go nuts. Glad you're going to talk to us about how we can trade actively in the market if you only had a couple of hours in your day to trade. And what you'll find is if you start watching the market at a certain period during the day, wherever you are, you'll start to learn which pairs are trading actively and which aren't, and it'll make you a better trader. Here's an extreme. This is the 1-minute chart. And again, even within the 1-minute chart, look at all the movement that's in there, the up to down, the up to down. So that's illustrating the point that there are pips out there to be made if you are actively engaged in the short-term trading. Now, you're going to have to be trading off a 15-minute, 5-minute, or 1-minute chart for your setups and your entry and your exit, but it can be done. There's opportunity within, you know, this move here. If we showed you this one, you'd say nothing happened. You look at this one, and by the way, this is a two-parter because it being a 1-minute chart, I couldn't fit it all on one page. That's the movement over the similar time frame based on, again, 1-minute chart, a bit extreme, but it shows you that movement. And the other thing I do want to point out is that the Fibonacci retracement, for example, as with any of these, the moving averages, any of the other studies that you want to do, can be applied to different time frames. Now, I will tell you that you may find that, for example, the Fibonacci on a 5-minute might be a bit extreme. I don't know what you would do with a Fibonacci on a 1-minute, but it may or may not work for you, but you can at least begin your analysis, find out what works for you, find the trading ideas and concepts that work, and you can put a Fibonacci on a 1-hour or a 4-hour besides a daily. Those same ideas can apply. Now, what will happen is as the time frame gets shorter, some of those moves can be not quite as dependable and can be a little bit more exaggerated just because of the nature of a 1-minute or a 5-minute chart. But if you look at this, from the top to the bottom of this move, we did break through the 50 here, but then we came back down and settled around the 23.8, came back up to 50, came back down to the 28, back up here to 50, bounced across 50 a couple of times. So it's really one of those where in this particular instant, just an example, but those sort of trading techniques do work on these shorter time, multiple time frames. Trying to flip this screen for you guys. Here's what you want to do. You want to apply the same trading strategies used for equities, options, and futures. Those ideas, those disciplines, those mental discipline, the psychology, and the techniques you've learned can be used to do this. So don't think you're going into an arena that's completely false. You want to focus on shorter time frames to execute this. Probably looking at most a 1-hour chart down to a 15 and a 5, maybe the 1. You do want to actively manage these positions. Be willing to put tight stops, take quick profits, and then OCO with trailing stops. And the key here, guys, is you really want to make sure that you have a strategy that says, I'm willing to lose, 10 pips to make 15. And when you make 15, protect yourself, maybe try to ride it and maybe make a little bit more, but definitely put yourself in a position where you are taking taking losses out of the picture. The opposite is not true. When you get stopped out, and you all probably, if you haven't done it, you will do it, I don't want you, as it's approaching your stop, grabbing your mouse, dragging the stop loss trade out of the way and letting the losses continue to pile up. I know how difficult it is to take losses. I can promise you, if you combined all the bad trades and all the losses that everyone on this call has taken, I've probably taken more bad trades and taken more losses. So I understand the temptation and the frustration when a trade goes against you. And I also know that I just had one the other day where it felt like the underlying knew, and I forget what trade I had on. I think I was short the pound dollar. And my stop was at, I think it was 138.33 is where my stop was. And I'm telling you, it took a beeline to 138.33. It felt like it traded exactly to my stop, and then it went the other way. And it happens. And I find for me, the worst thing to do is worse than taking and moving your stop loss to stay in the trade. It's when you hit your stop loss and you haven't had time to reassess, you jump back in and double down. And it's chasing. You were wrong, and sometimes you need to look at getting taken out of a trade as the opportunity to reassess, because I know for a fact it is much easier to initiate and open a trade without a position than it is to try to wiggle your way out of a losing trade. Everybody does it, but as they always say, just because everybody does it doesn't make it right. But I know what it's like. I find it's easier to make a decision with a clearer head once I'm out of the trade and then reassess. Let's remember, pips are pips. Make 100 pips a day on a 2-day trade, the same as making 10 pips 10 times in 2 days. So it's all money in the bank. And I used the word before, I want to use it again. You want to build your confidence and improve your eye for the pairs you trade. The more time you can spend in your demo account making mistakes and getting your repetitions in, the better trader you will be when the money goes live and you're involved. Because I know it's much harder. Trust me, I know. It's much harder when it's live. No matter how good you are in a demo account, there's a different switch that gets thrown. Even if it's small money, it's still your money, and you have to be aware of that. I do want to talk about one trade. It probably would not be a very good trade to do tomorrow because of the holiday issue. But in general, there's a trade you can look at the end of the week. As we know, the equity markets around the world close every day. They open in New York at 9:30 in the morning. They close at 4 o'clock every day. Tomorrow they'll be closed all day. The currency market opens up about 8 p.m. or so Eastern time Sunday night in the U.S., closes about 4 p.m. Eastern time Friday afternoon. And in the interim, the market's always open. And one of the factors of that is it allows someone to use the management, and they can manage a trade and mitigate some of the unknown risk because the market's always open and they can put stops and things in place. And what you'll find is that you want to look for an actively traded pair that's made a strong move up or down over the past week. Why are we looking for that? Because traders who have made money, again, we're back to the psychology of trading, that there are people behind the screens, will naturally look to take profits as the markets move towards a close. Once the market closes on Friday in New York, there is an added layer of risk involved in trading because you don't have buyers and sellers together. You could have a gap in the market. Last weekend, we had a gap in the market when we opened on Sunday. If you left the position open, you could have, taken unintended losses or profited handsomely depending on which side of the trade you're on. But that becomes more of a gamble than a trade. This trade should set up in the morning in the New York trading session as we begin to wind the day down. Just want to give you something to look for on a Friday, not tomorrow, but most Fridays. Here's a look at the U.S. yen daily from, I think, 2 Fridays ago. And you can see we had a significant move. It was a 6-day move to the upside. Up, 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 up. There is an up, 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 up. And the natural inclination of the market is to see that the buyers run out of steam, the sellers look to try to reestablish. And what we were trying to find is, was there an opportunity for a short-term trade to kind of capitalize on that end of the day reversal, end of the week reversal. And here's the trade that we did in this neighborhood about here, up in here. You can see that the market began at the end of the day on Friday to sort of work its way down. As the sellers looked to take profits, the buyers, recognizing the sellers had profit to take, moved out of the way of the offers and lowered the bid. So it's a short-term trade looking for a setup that happens at the end of the trading sessions. Here it is on a 1 hour, and you can see, again, it kind of, this particular week, as we got to the end, it sort of ran out of steam, the trading in this area here, and then it was sort of the setup of, okay, now we may have an opportunity to catch this downside move. This is a short-term trade only for Fridays. Don't go looking at every one. You really need to have had a strong move, and it's a counter trade, which are sometimes very hard to do. If something's been up, 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 it's a lot of times difficult to say, I'm the guy that wants to get shorted, because you feel like, and let me show you, you feel like the moment you, even back to the one day, the moment you sell here, the next trade prints way higher and you get run over. So there is risk. There's always risk in trading. But here it is on the 15-minute. And again, this thing reversed out and closed down hard, making a pretty decent, it moved down from levels like 103, I think it was like 103.90-ish. This moved probably 80 to 100 pips to the downside in that afternoon. And then there's the 5-minute. Again, this was the 15, and that's the 5-minute. You can see that these levels here up at the top of the screen, it traded up as high as like, geez, just over 104, and then closed down in the neighborhood of like 103.25. So about 75 pips down off the highs in what appeared to be, driven as much as anything by profit taking by probably those who had ridden it to the upside, sort of ran it out of gas. And there it is on the 1-minute chart, showing you that there were a couple of opportunities. It wasn't a straight move down. There were opportunities to sell along the way, even if you weren't able to get in on this trade, here, here, even if you got in here and it went against you a little bit, it eventually worked its way down, up again and down. So it wasn't a straight line like this down. There were opportunities within the move, as we've been talking about. There's opportunities within the move to capitalize on the overriding trend of a down. You were probably able to get in and make some money if you played it on this side of the trade. And there, the end of the week, again, 1-minute chart takes a little bit more graphically to get up on the screen. So this trade benefits from the natural ebb and flow of all trading markets. Similar price reversal, you may be familiar with the end of the close of each trading day. A lot of times you'll see that a market will charge during the day, and then at the end of the day, you'll hear them talk on CNBC about, there's profit taking in the market, people squaring up their positions, living to trade another day. This is a trade you do want to use tight stops for, and you do want to actively manage. And what I mean by tight stops, if you go back to here, for example, let's look at this, the setup here. Let's say you got into this trade. Let me take you down to to this one. Let's say you got into this trade, in this area here. You probably would want to put your stop up right about where you may not have gotten taken out, but that's not a lot of pips. That's about a 15 or 20 pip stop. You don't want to take a chance of getting on the other side of this trade and then not realizing that if it breaks through, when you're wrong, you got to get out and live to trade another day. I'm not telling you that every week this happens. I'm not telling you every strongly traded pair or very weak pair is going to reverse, but there is opportunity out there if you get the correct setup. The one I like is when it's really trades for a decent period of time on the chart, kind of in a sideways, nobody can kind of get control of the market. And then a lot of times the people who have been long, in this case, hoping for an upward move, kind of give up, time's ticking, and they look for an opportunity to get out, and that can soften up the market. Before we get to this, I do want to jump into, I want to share my, my desktop real quick. I want to show you a couple of trades that I'm looking at. Let's be clear. These are for educational purposes only. Please, 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 please do not go putting this in anything more than your demo account. We had been looking at this is a trade I had been following. This is a 4-hour chart of the Aussie US dollar, and it's been sitting on these levels, feeling like it wants to break over the last couple of days. Quite honestly, I'm sitting with a very small long position here, and the reason is I'm looking at some other stuff. The biggest reason is I think we have some support only about 20 or 30 pips away. There's some other reasons why, but in general, I'm long this trade right now. Again, very, very, very small. But the general uptrend, well, I know that yellow is probably as bright on your screen as it is on mine. But in general, since about down here, you could draw a trend line up if you tighten it up. You know, you could draw a trend line up here. So in general, we are in an up move, and I think this might just be a bit of a pullback to support before we continue the move. So I happen to be long it. Again, this is for your demo account only. One of the other ones that I'm looking at that just kind of interesting that let me find it for you here. The US Canadian. And this one again is a the US Canadian. I'm sorry, I got to tile these so you can see them a little bit better. This one has, you can see on the daily, it moved to a downtrend and has been putting in lower pivot lows. And on the 4-hour, it's again, we could probably drop a Fibonacci on here, and I'll bet you we'll find that we are sort of kind of, wow, didn't plan that. But you can see this, and I'm going to annotate on this really quickly. I know we're getting up towards 8 o'clock, but I do want to kind of illustrate this for you guys. If you look at this level here, and that's the 38.2 level, you can see how much price action we had right in here, and then it traded off and hit it, came back here, has traded again, and so it looks like to me that we might have the ability to get this thing to move and more back to the downside. It's what I'm looking for on this trade, but it's a I didn't even know on this hourly, this 4-hour that that the Fibonacci fell. Just kind of interesting. And then if you look at the closer into say a 1 hour or 15-minute, we've got a decent stop that we could put in. If you use this area as your high, you're only looking at currently, 20-some pips to be wrong. But if you were, right, next spot you really need to clear is down probably in the 35 to 40 pips, and you could get a farther move to the downside. So that's another one that I'm looking at. Again, please, please, please. This is for your, and for those of you, just one other interesting thing. If you look at these charts, I can't do the overlay, but if you look at the Euro-Canadian chart, it's going to look, I'll throw up the, what did I throw up? It was the 4-hour with the Fibonacci. Yeah, now this is the Euro versus Canadian. And take a look at how this, probably for most of you, it should almost look like the exact same chart. I'm trying to draw it in here, but you look at this and it's, within reason, it's right about the same chart. So just showing you that Euro Canadian and the US Canadian, not surprisingly, both traded opposite the Canadian dollar, are something that are going to mirror. And what I'm going to tell you that is you have to be careful. So for example, if you got short the US dollar, Canadian dollar, then you got short the Euro Canadian dollar, you really have a double short on, because you're effectively, as you can see, at least in this shorter term, they're moving in a similar direction. When they go up, they probably go up together. When they go down together. you have to be careful of that when trading, that you're not doubling up or doubling down inadvertently on a trade. So I'm going to stop sharing here, go back to our presentation. Mentioned it earlier, but if you can give our team at Cyber Trading University a call, this special offer, they haven't offered it this kind of a deal. It's Fausto and I talked about this, and it's really a great opportunity to look and learn and watch traders for 29 bucks. You get 2 weeks in this cyber group starting Monday the 21st until Friday, May 2nd, because we're closed tomorrow. We can't offer it tomorrow. So it starts Monday, and the only way to take advantage of it, you have to call the team at 877-70-CYBER, or you can reach out from your desktop to the contact information there. But you get the cyber trading group for 2 weeks, and you get to come back at the end of the month. We're going to do more of an in-depth FX Pro trading night. So reach out as soon as you can. Think about, if you're serious about your trading, there's really nothing better than watching someone do it. It's hard when you're trading by yourself. And when you can join a group and you can watch the group trade and you can see what people are doing and how they're executing properly, it speeds your learning, builds your confidence, and will more quickly make you a profitable trader. So because you joined us here tonight, 29 bucks. Be happy to have you in the cyber trading group. I'll be in every morning at 8 o'clock, give you a little FX preview. Fausto will have the room open all day, regular New York trading hours available for you. I believe it's also recorded if you need to check it out later. So those are available to you. It's a great offer for 2 weeks. We hope you'll join us. This is Greg McDermott for Cyber Trading University signing off. Thanks, guys. Everybody have a great evening.